Now, what do you know if you can think about um, non-trending markets? If you can find clues from non-trending markets that say the market is non-trending, and you can use those clues, those maybe technical tools that allow you to define risk, allow you to see which way the market is going to the upside or the downside. You can start to anticipate a trend and also have a better chance to stay on a trend. Because imagine this, folks. If you see a non-trending market and the market's non-trending, what do you know? It's going to trend. So guess what? When it starts to break out, what are you going to be more inclined to do? You're not going to be more inclined, or you should not be more inclined to take that 10 pips and run, right? You're going to be more inclined to sit on your hands. Why? Because the market's going to trend, or has a good chance to trend. It doesn't happen all the time. Yes, you're going to get stopped out when the market doesn't do what it should do. If you think it's going to trend and it doesn't happen, that happens. But you're going to risk very little on those types of trades, and the ones that you're going to catch, those trend moves that you're going to catch, are going to be real meaty trades, or have the potential to be real meaty trades if you can stay on them. You have a better chance to stay on a trend if you're looking for it, right? Yes, makes sense, doesn't it? So start to look for and anticipate trends. Start to use some of your tools. We're going to go through those examples here in just a second here. So I think let's look at some examples of what to look for in the chart. So here we have the euro versus U.S. dollar. This is a daily chart, and I use 3 different types of time periods in my analysis on a daily basis. And I don't go into too much detail of how I transition from one to the other, but I will say that in what we're going to learn here today, the dynamics of defining non-trending markets, looking for and anticipating a trending market, are all the same. I use the same tools in all the charts. One is the blue line that represents our 100 bar moving average. In this case, it's a daily chart. That's the blue line. The green bar represents 200 bar moving average, and then I use trend lines and I use Fibonacci retracements. I don't have a Fibonacci retracement here, but because the market is non-trending, I can connect lows to lows, and here, a nice little trend line, 1, 2, 3 different points along that trend line. Oh, that's a significant little line right there, isn't it? Especially in a non-trending market. But what I want to look at on a chart is when I see a narrow range like we have right here, that says something to me. It says, if you look back over time, there's probably not a number of days in a row where the range is as narrow as it was in this period right here. And when I see a narrow trading range, and I see a narrow trading range get even more narrow, or narrower, if that's the word, I start to think, oh, this market is non-trending. This is giving me a clue that the market is non-trending. What do I know? I know that at some point, traders going to move this market one way or the other. Either it's going to go to the upside, it's going to go to the downside. So I start to wear my best suit to work. I start to think in terms of, all right, what is going to take me? What is going to allow? What clues am I going to take from this chart that's going to say buy it? Or what clues am I going to take from this chart that's going to say sell it? And I'll start to define those levels. And so just looking at this chart, looking at the narrow trading range, you can simply take the highs and lows off this trade. You can take the high trend line, you can take the low trend line, you can take the 100 bar moving average. All these are within a fairly narrow trading range here for your trading. So that's good. That means that you can define your risk, you can limit your risk to a fairly small amount. And all you have to do is kind of catch that move where the market's going to trend, and the trader's going to jump on it and move this market one way or the other. So that's what I look for, is a narrow trading range. Then I may look at for something else. I may look at the 100-day moving average. That's the blue line in the chart in this case. When the 100-day moving average flattens with little or no slope, what's that saying? It's saying take 100 days. Take, not quite 1/3 of the trade. Well, it is 100 trading days in this example. How many trading days are there in a year? Well, there's 5 trading days in a week. So we're talking about 20 weeks of trading. Take 20 weeks of trading, and the average over that time is creating creating a line with no slope. What does that say to you? That says the market is non-trending, doesn't it? What do non-trending markets do? Transition to trending. So, clue. We got a narrow trading range, and we have a 100-day moving average moving sideways. slope is narrow. When you see a bunch of bars where you have green and red over this period right here, this is an extraordinary period where we have red, green, red, green, red, green, red, green. The market gets tired of that, doesn't it? It starts to lose interest in that type of market. So what happens? We start to get a more narrow trading range at this point right here, and that's a coiling of the market. The market is basically saying, I don't know where we're going. I really don't know. There's things that say take it to the upside, and things that are saying take it to the downside. It's okay for the market to have that feeling for a while, not too long, because once again, you're not going to make any money if the market just says, okay, we're going to just stay at 144.31 for the entire year. No one's going to make any money, and everyone's going to get fired. We're not going to have retail foreign exchange, so it's got to move. And thankfully, we have the big boys who are going to come in there and going to move the market at some point or another. They finally figure out, I got to make some money. My boss is getting on the case, so they sell it or they buy it. And so it says to me when these dynamics start to happen, it says to me, start to anticipate a trend. Non-trending transitions into trending. So important. Have that idea, that methodology, that idea in your mind of what that's going to happen. So what do we see? We see the market start to move. I'm not surprised. It was all set up in this area right here. The 100-bar moving average is right around that area. We had lows. 9 days, 215 pips in the trading range. The average trading range for a day in the euro last year was 157 pips. That was the average for a day. So here we had 9 days, 9 times 1, with a 215 pip trading range. Non-trending markets transition into trending markets. So we had all these clues here. We had the highs here, ceiling. We had the lows here, floor, 100-bar moving average line across the bottom. We have this trend line coming across, and we have these lows right here where the trend line came across. So in this bar right here, where the market crossed through the 100-bar moving average, through the lows, that was the floor for our 9 days. We crossed through the trend line that has held for 2 months now. Is that something that says to you, there's a little bit of energy in the market now, more energy than what we saw back in this period right here? Yes. Start to think trends. Start to get in. You should be thinking in this area right here when it starts to really move below the 100-bar moving average in this line right here. I'm a seller. I'm looking to sell this market. Where's my stop? If it goes back above the 100, if it goes back above here, I'm willing to risk this amount for the potential for something. I don't know how far it's going to go. No one knows how far it's going to go. All I know is that I have my entry. I have a reason to trade. I am confident that this reason should lead to something great, a trend.